freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here today, as always, with Adam Penn. Adam, what's up?
That was a great intro. Your voice got deeper towards the end.
I feel like I'm starting to say these more like I'm like an announcer or something.
Like a late night DJ FM voice, like Chris Voss tells you to talk with in negotiation.
It's exactly right. Yeah, the late night DJ. Yeah, it's exactly
late night
right.
FM DJ.
Yeah. He always adds that. Not the AM DJ.
No, those guys are not chill. They're not good hostage negotiators. Those guys are just giving you the weather.
That's or they're playing terrible music. Speaking of AM radio, I was in a. We haven't talked about this on the podcast, but I'm taking flying lessons right now. We were up at another airport nearby, and all of a sudden, off one of the ends of their runway, we started picking up some country music on the
on the AM band
on their frequency. So it made me think. I was like, it's probably some AM station. Now I want to go back and figure out what was playing up there. But yeah, that's the only exposure to AM radio I've had in a while. It was inadvertent.
In high school, we built an AM antenna. I remember doing that. And then I asked about FM, and the instructor was like, that's so much more complicated. Well, I'm not going into that right now.
Did you have to get like an FCC permit for that?
No, because you're just building an antenna, like a receiver. Okay.
Well, what's the point of building an antenna if you're not going to broadcast?
It was high school, Dustin. It's government control. There's no point to it.
It's a fair point. Oh, well, that sounds complicated, which is the opposite, or maybe is what we want to talk about today. I think that was a terrible lead in. It
was, but we're going to go with it. So we're talking about keeping it simple, right? So
keep it simple, stupid.
Oh, KISS, which is really, I think the main talking point here is that we have investors we talk to or other deals we see where they're complicated, right? And there's fees on fees. And we've talked about this loosely, but I don't know, you brought up some points kind of before this recording of maybe misconceptions that people have or conversations that we'll have with investors, and they want to know why it's not more complicated. And do you want to run through some of those?
Yeah, I mean, it's kind of interesting, and it's not something I think until I started getting around this space more and talked to some people. And my personal philosophy has just always been, if you can keep something simple, like why make it complicated, right? Like there's the saying that simplicity is the ultimate sophistication or something like that. And which I think I picked up long time ago from Mythbusters, right? Like Jamie Heineman was big on simplicity, right? If you're making something overly complex, it was probably going to break and it was probably going to have issues. And I think in some ways, that's definitely true, and it can apply in investing. But the problem is, just like someone who will see some object or thing or whatever that's like crazy engineered, and because it's complex, they will think, oh, well, that must work really, really well.
Yeah.
You can't always equate this complexity to being good, right? I mean, it might be sophisticated, but maybe not in the way that you want. Maybe it's over-engineered. So I don't know. There's a few different ways we can take this, Adam. I don't know if you want me to keep going.
I think start diving into some of the items, and I can add some context, but maybe around deal structures that you've seen that are maybe more complicated than they need to be.
Yeah. So in the private investing space, I think where this shows up, you see the most unnecessary complexity is in deal structures, and so the way that typically shows up is in a very complicated waterfall, which would, no investor left behind, is just this sort of increasing, as the return goes up, the return or the splits between the GPs and the LPs will change. And typically the way that you see this is that as the overall return of the deal goes up, the GP gets a larger share of the split. And the argument here being that incentivizes the GP to hit those higher amounts because they're going to get a larger share of those returns. I won't get into an example here because I'm likely to mess up the numbers, but actually I will now that I say that, because I think it'll illustrate the point. You would, a very simplified, like if you had a 2-tier waterfall, you could say at up to a 15% return, it's a 80-20 split between, the investors, the LPs get 80, the GPs get 20. Anything over 15% could revert to a 50-50 split. So now you're splitting everything above 15%, 50-50 with the GP. So that means the GP is really, really incentivized to try to get to that point, because now all of the returns over 15% are being split in half. And
so for every dollar that they earn for the investor, they make $1 at that point.
Exactly. That's exactly right. And so
that seems like a good structure, right? Like I see incentives there, but
it does. I agree. And I think when if you've got a simplified waterfall like that, if that's about as complex as it gets, that's not really bad.
Well, I have seen some that are like at 12%, we get this, at 13, 14, 15, and it goes all the way up into like a 17% IRR, where they're getting a 90-10 split, 90% to the GP. Once again, super incentivized. But like, I know the paperwork that would have to go on behind the scenes to like figure all that out. And most of this is happening at a sale. So it's not like they're really doing, like, they're probably modeling this on paper, but they've modeled most of what they're going to get. And since most of this is happening on a sale perspective, there's just a way for them to make sure the investors get a decent return. And then they start taking more and more as the IRR is better. Obviously, it means they made the deal perform really well. But back to like all of the steps that got you to there, in my mind, are like the day-to-day operations. And so that's why we normally lean really close to an 80-20 split. Point blank, right? Cash flows, refinances, sales, everything's 80-20 once the investors are made whole, right? Like cash flows are normally 80-20, and then, a sale would be investors get paid back, and then the profits are 80-20. It just keeps it simple. It keeps it simple from day one operations that both parties are getting paid, right? Because at the end of the day, this is not one of the things that I really like about this space is it's not Wall Street, right? It's not a stockbroker who's working with a larger mutual fund who's then putting money into 7 different deals, and it's a large ETF. And this shows how little I probably know about the stock market. I probably said something wrong there. But there's all these layers and all these people. Versus here, it's like, in August, we closed on a building in Chico. It was a 20 unit, 6 people, me and 6 people, right? There's 6 people that I call friends. And so if I have 6 friends that I'm working with on a deal, like, we don't need some crazy entity structure and splits and blah, blah, blah. Like, it's a partnership. You form an LLC, you buy a property, I do the work, I get a cut.
Yeah. And that's definitely, as you said, that's the side we err on. And I think from an administration standpoint, I think that it's easier. It's less paperwork. It's way less complicated for us to try to figure out. But I also feel like you'll get people that say, well, what's your incentive to get those really high returns? It's like, well, I want to try to get the highest returns out of the deal that I can. But we're in the same position as
20% of it.
Exactly. Like we're still going to be splitting it. Like I don't need this like crazy waterfall to make me want to try to get the best returns.
And most deals, I think in general, the ones that have good cash flow right now, development deals aside, but the ones that have good cash flow right now means that the higher the cash flow I can get right now, the more money I will make as a 20% stakeholder, meaning the more it'll be worth when we go to sell it or refinance or whatever it is we do, such that it's just equal all the way through, right? If I'm just an owner and a 20% owner, same as the next person, then we're aligned, right? It's just equal to me.
I agree, and I think even the returns to the investors, I don't think end up being that much different, because the reality is those, as you get into those upper tiers or the lower tiers, I guess if it's a waterfall of maybe it's upper, whichever way you go, you get into the upper tiers of this this waterfall, it ends up actually being a smaller and smaller slice of the deal. And so, I honestly have
unaligned with investors.
And I haven't run the numbers on something like this, but my guess is if you were to look at the total returns and probably total cash to GPs and LPs in a crazy waterfall deal structure with all these tiers and something that's more simple, it probably works out to be roughly the same.
Probably about 80, 20, 70, 30, somewhere in there.
And I think that's something, Adam, you and I have both seen this, that it seems like no matter what sort of structure you put together, if it's a solid deal, we're generally talking here like a multifamily value add type deal, it's all whether you, and this thing gets into, are you doing a preferred return or not? It all generally kind of evens out to somewhere in that 70, 30, 80, 20, maybe 85, 15. We know some folks that do that. That's where it all kind of ends up into the day. And so I think this gets into the point that maybe the mistake that I see investors making, because I've certainly heard of folks who they look to those more sophisticated, I'm using that in finger quotes, these sophisticated waterfalls or the complex waterfalls, and they will associate that with a higher degree of sophistication with the sponsor or the GP. And that's not always true. And so I have heard of GP or LPs who will not invest in deals with just a straight, 80-20 split because they perceive that to mean that the sponsor is unsophisticated. That if they're not doing these incredibly detailed waterfalls, because why wouldn't they? It's the sponsor's incentive to do that. And so you have investors that will view the lack of that as a lack of sophistication on the sponsor's part. And that's just not true. Some of the most successful investors that we know do straight splits. They don't do preferred returns. They don't have any waterfalls. It is a straight split from the start of the deal to the end.
Some of the most successful investors we know would get incredibly confused if we even tried to explain to them what a waterfall was.
That's exactly right.
So I think what might be interesting here, and then maybe you'll think of something to add on top of it, but I want to walk through a deal that we just did that popped into my head, and it was a one-off deal with a partner. I had one partner on it, and it was a flip. We did a flip in Chico, and the guy was a realtor. And he found the deal, and I did all the rehabs on it. And we both brought money to the deal. We both brought debt to the deal. We had both of our families basically financed it, and we paid other family members as a loan. And we were kind of negotiating the beginning of the deal, and he said, I found the deal and I'll sell the deal. He's a real estate agent, and we'll do 50-50. And it was just simpler that way, right? We're not paying him a broker fee, right? So he's not getting paid for his time for selling it. He didn't get paid for finding the deal or selling it to us collectively. I don't have a professional license, but I'm not paid for doing the rehabs or managing the subs or any of that, right? I'm just an owner builder. And so neither of us are paid for either of those, and neither of us are having to track those things. Neither of us are having to add that complexity to the deal of, okay, well, if it sells for a little more, well, why is that partner getting paid so much just for selling the property when I had to put 100 hours into rehabbing it, right? And once again, I'm not thinking about, the time I had to put into rehab it, or actually on this one, my crews did most of it. I ended up putting like 20 hours into it, maybe 30. And my painters and stuff did most of it. It wasn't a hard flip. So at that point, it's like, well, Adam, you didn't do a whole lot. It's none of those conversations. It's just, we decided on 50-50 and neither of us take any type of fees. Well, the better we can make the deal, the better it can perform, the more money both of us make on a 50-50 split. There's not one way one of us could leech something off the deal there.
Yep. Yeah, and that's why, I think so much of this, you get people argue for, well, the waterfall and the crazy tiers.
And the fees.
What's that?
And fees.
And fees, yeah. Well, maybe not the fees, but that the tiers will give incentive to the GP. But I feel like in some ways you can argue that it skews the alignment out, right? Because now, okay, is the GP going to maybe do things that might be riskier than necessary on the deal just to try to eke out those higher returns when it wasn't really necessary? And now they've ended up taking more risk than they should have, and it hurts the deal as a whole. So,
and it really didn't change the underlying return much.
Exactly. Exactly. If in end of the day, even if those higher risks work, the return difference wouldn't have been vastly different than a 80-20 split.
Yeah.
So you get people that will argue for this, and I'm not saying it's wrong, but I think you need to be aware that it's not the end all be all, and that if you see a deal that has these crazy waterfalls, well, that means that they're very sophisticated, and if they're doing this waterfall, they obviously know what they're doing. It doesn't, the presence of a complicated waterfall does not signal competence, and the absence does not signal incompetence, right? Like you can't really use this as a way of judging the quality of a deal, and some people do that, and that's the big mistake in my mind.
You want to touch on anything around prefs, or you want to kind of call it there?
Oh man, prefs. Yeah, I mean we've talked about prefs before, right? Prefs have their place. So a preferred return, again, no investor left behind. If you've never heard this before, this is where a preferred return would be a certain percentage. Basically, you get first cut, right? And this is not a guarantee. That's another thing. If you ever hear someone saying that a preferred return is you are guaranteed a certain amount, should probably run the other way, because a preferred return is not a guarantee.
I'll give an example real quick of where I think a preferred return makes a fair amount of sense. Our credit fund is essentially a debt fund. So, I mean, it's not. There's technicalities behind it. If you're interested, reach out to us. But the credit fund has kind of a fixed return. We call it about 12%, 14%. Let's call it 14%. And so what we do in that is we say the first 6% is going to be preferred to investors. And that works out to be 0.5 point a month. So then we're flat paying 0.5 point a month. Makes a lot of sense because we have a really clear cash structure in this fund, because most of these are structured as debt payments or preferred equity where there's payment schedules. So we know we're going to be able to pay that every month. Then the second part is that the upside on top of that 6% or that 0.5 point every month is split 80-20. Makes a lot of sense. Once again, keeping it simple. We know we're going to have these flat payment terms with most of our deals. So we'll be able to meet 6% seems reasonable. And then everything above that, which if we were getting an average of a 14% return, would be 8%. So then the 8% would be split 80-20, right? 1.6% of that coming to us as general partners, and the other 6.4% would be going to partners, giving us a 12.4% return to partners, right? And that's not exactly the numbers, right? Once again, there's no guarantee in any of this, but it's just structured well because of that type of deal. Now, maybe give some examples where a pref, and that was a pref, and there's no catch up on it. Sometimes the spots where I think prefs are really stupid, and we did one of these deals early on, is where there's a pref and then a catch up afterwards.
So is that like
not like mustard?
Oh,
no.
Okay.
So there's, I know it's hard, especially when you're hungry. It's almost dinner time over there. So the pref with a catch up is where you have, let's say it's 6% again, and afterwards 80-20. So if you get to a 10% return in a year and there was a catch up, it means that you're going to get 6% and the next 1.2% goes all to the GP. And then everything after that's 80-20. So if these numbers are a little confusing, you kind of just cycle back to the fact that this thing should be simple, because that there, all it does is just front load returns to investors, pause it for a little bit, then split, and you're back to, it's literally the same thing.
I'm glad you said that, because even though I think for certain types of deals, I'm pretty anti-pref. Now, the biggest reason people do those are for marketing reasons. And the psychology here is, from the GP's point of view, is, well, if an investor is looking at where to place their money and they can put it in 1 month treasuries at 4.3%, then I need to offer something that would seem to annualize at least a little bit higher than that as current cash flow, so to speak. So I get the argument. The problem is, in a lot of deals where it doesn't make sense to do it, there actually isn't cash flow right up front. And then to what Adam talks about with a catch up is you can have an accruing pref, which is where, we're going to pay a 6% pref, but there's no cash flow in the first 2 years. So effectively, starting in year 3, well, that does 6% for the first year. So now you got 12% that has accrued and is due. And that's because of the structure. Again, it's a preferred return. So that's due before the GPs ever get a dime. And so what can happen, and what has happened a lot in the last few years, are GPs will get behind because of this and eventually end up in a point where they're never going to make any money. Because
we'll clarify really quick that they'll make money on fees or other transactional maybe items, but they're not. It's almost a disincentive for going and keeping the deal performing. They're so far behind. There's no way that in the next 3 years they could catch up that 12% pref, or if it's never endingly accumulating, they would have to get to a year where they're making 30% that year. It's only going to happen on a sale.
And so anyway, the prefs can make sense, but on the whole, I feel like they have more downsides to investors because of, again, like we said earlier, a deal with a pref and a deal without a pref really doesn't change the total return to an investor. I mean, it shouldn't, right? In theory, it's just saying, hey, this first amount of your return or the first amount of cash flow from the deal goes to you. It's not really modifying the return. So, yeah, I don't think that you should, as an investor, a passive investor, I would not recommend thinking that just because a deal has a pref that inherently makes it a better deal. It could, depending on the structure and how well the deal goes, actually end up as a disincentive for the sponsor to do work on the deal if they fall so far behind on an accruing pref that they're never going to get paid. And so, again, generally, because I don't see that it has, there is, in my view, and Adam shares this too, there's more downside to a pref in a like value add multifamily deal than there is upside for the investors. Even though there's this marketing angle for the GP for trying to raise capital. But I think if we're actually looking at what's going to be most in the investor's benefit, there's very few benefits to a pref, and there are downsides. Adam, did you catch that fly?
There's a fly flying around my head. It's kind of annoying right now. It's like a little gnat.
Oh,
I might have got it. Anyway, I mean, I think we kind of beat that fly to death, but I think the point is simple is normally better, and I think that's true in a lot of deals, just across the board.
It goes back to what I said. Like, I don't think you should look at a complicated deal structure and view it as a sign of competence of the person offering the deal. I think if anything, it just provides more places for things to go wrong and for there to be confusion, potential mistakes, things like that. So my takeaway advice here is don't look for complicated deals and think that those are going to be the best ones. And don't discount simple deals. Again, like we know plenty of people that do straight splits and they do absolutely amazing deals for their investors, and their investors always win. And there's nothing complicated about any of those deal structures. So that is not the quality to be evaluating a deal on. Anything else, Adam?
No, nothing else from my standpoint.
All right. Well, to your point, I think we beat that fly, as you said, to death. We'll get on out of here for this one. If anybody's got any questions on this, feel free to write in. We'd love to, this is one of these topics that, especially if you're new to the space, it can definitely be confusing. Some of these terms and what's a pref, what's a waterfall, how does all this work together? So if you ever have any questions, we'd love to help. Got a contact form on the website, wealthindependencepod.com. Go check it out there and submit if you got, again, questions, comments. And we always have to mention, let the computers know if you are enjoying this. Let them know that you're enjoying it. Go like the video if you're watching on YouTube. Give us a positive review on iTunes or whatever you do on Spotify. I don't use Spotify, but give us a thumbs up or something positive. Let the algorithms know that you're enjoying this, and get this message out to more people. But with that, we'll get out of here for today. Appreciate you listening, as always, and we'll catch you on the next episode. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.